Well, good afternoon. We're here for our discussion of qualified opportunity zones today. My name is Brian Wade. I'm a certified financial planner with Tampa Financial Group. Joining us today, we have Jake Muehlschlegel with IFP Securities. Say hi, Jake.
Hey, good afternoon, everybody. I'm the alternative investment analyst here. So my three primary roles are: one, sourcing new investment opportunities; two, performing initial and ongoing due diligence there; and then three, shelf consultation for Brian and our other advisors as well for what we think are some great opportunities in the market.
Thank you, Jake. Thank you for being here. Thank you for organizing this today. We have Sean Raft with Urban Catalyst. Say hi, Sean.
Hi, everybody. It's an honor to be here. I am Sean Raft. I'm a partner, general counsel, and CAO at Urban Catalyst.
Great. And then finally, we have Larry Goff, president with S2K Financial.
Hi, everyone. My name is Larry Goff. I'm the president of S2K. We're a managing broker-dealer that represents a number of tax strategies, and I live in Orlando.
Awesome. Tampa, Orlando, here we are.
There we go. Got the Florida boys. That's right.
So let's get right into this. Sean, can you tell us what are qualified opportunity zones and why were they created?
Qualified opportunity zones, that's a term for a tax benefit program that was part of the Tax Cut and Jobs Act in 2017. This was an idea by Sean Parker and his think tank that predated the Trump administration at the time it was passed. The idea was to take capital that was on the sidelines and deploy that cash to utilize it in the revitalization of urban centers, to use private capital to do that work. And so that's why there's the tax benefits, so that to incentivize folks to liquidate assets, take those capital gains and plug them into designated opportunity zones to revitalize our aging urban centers.
Okay, great. And Larry, what would you say are the benefits of a qualified opportunity zones to investors?
Well, Brian, there's a number of benefits. The great thing about the program is that it does a lot of great things for a lot of different groups of people. So for one, it is not tax avoidance, it's a tax deferral. And so the capital gains that one might be might owe the government from the sale of a business or long-term or short-term capital gains in stocks or real estate, they just pay it later. Mm-hmm. The great news is it encourages development, as Sean said, and it really helps state and local governments as well, because those developments that may not happen without the tax benefits create a lot of state and local taxes when they happen in the different cities where there are opportunity zones. And then the big benefit for the investor is any gain that you create during the time, that 10-year time frame of the opportunity zone, you don't have to pay tax on later. There's some other benefits like passive losses that you can utilize against other investments, but that's a big win. And I heard somebody say one time, actually Jeff with IFP said, you want to pay tax on the seed, not on the harvest. Yeah. And that's a great line, because what it really says is when the harvest comes 10 years from now, because you invested in this particular zone, you don't have to pay tax on that. So nice benefit for investors and communities.
Well, what's funny is, having been in the business 24 years, I remember that seed and harvest analogy more than 20 years ago.
It's funny because it's the first time I'd heard it recently when Jeff said it. And I said, Jeff, man, I love that line. I'm going to be using that line. It really does make a lot of sense.
Yes. Yeah. Well, it's definitely something to think about, because when people are making investment decisions, different kind of investments are taxed on the seed, the contribution, or on the harvest. Yeah. These are things that people need to be thinking about.
Yep, exactly.
So Sean, can you tell us, where are these qualified opportunity zones located?
Well, the way the legislation rolled out, the executive branch of every state governor's office, every state government had the opportunity to designate zones within their allocation. And so they did that back in 2017, 2018. And the final list of those zones are tracked on various websites. One that I might indicate folks can look at is Novogradac. They do our audit and tax work. and they've got a pretty good interactive website where you can check out and see exactly where the zones have been laid out in every single one of the states.
Okay. And Sean, can you tell us what type of situations might an investor buy in, and what type of capital could be invested in something like this?
Well, the great thing about the program is that virtually any form of capital gain, there are a few exceptions, but virtually any form of capital gain is eligible for investment into the Opportunity Zone program. In our experience, it's been the sale of stock that's been the most popular one of those. The big three would be the sale of stock, sale of business, and the sale of real estate. The sale of stock being number one for us. And I think that's because the sale of stock has never really enjoyed a tax shelter vehicle before. And so folks are pretty excited that, they can liquidate their portfolio apparently in this, tumultuous times with the stock market's ups and downs, and take some of that money off the table and then avoid or defer some of those taxes by plugging it into a QOF, Qualified Opportunity Zone fund, and then, gathering the harvest from those benefits, to use your analogy earlier, down the road.
Gotcha. So, and obviously this is not going to be a suitable investment for everybody. And Larry, can you tell us, in your opinion, what type of investor might this be a good fit for?
Yeah, it's for accredited investors only, and a lot of them have minimums starting at $100,000. A lot of the programs out there, some of them even much higher than that. So it really is something for somebody who's looking at a sizable tax bill that's been created through, as Sean mentioned, the sale of a business or stock or real estate. So that's something people really want to take into consideration.
Yeah, and now you say accredited investors, which is something we hear of in our business, but for the people listening, can you help them understand what an accredited investor, what is the threshold to get there?
Yeah, that's somebody with $1 million net worth that has that, or a high income. Sean, what's the income number now?
Yeah, it's 200,000 for individuals over the last 2 years, prior 2 tax years, or 300,000 as a married couple.
Yeah, so you could be an individual, you have to be earning at least 200, or a married couple, you have to be earning at least 300, or instead of the income, if you have $1 million net worth, you qualify as an accredited investor.
Yeah, the big thing they have to think about, Brian, is that you lock the money up for 10 years. So, this is the long-term money that you're really looking at when you invest in an opportunity zone. And if you do that, then you get the benefit. If you don't do that, you got a problem. So you got a tax issue. So you really want to look at long-term dollars that you can lock up for a 10-year time period.
Yeah. Yeah, and even as we talk through it, I mean, I can see how, the investor that it's suitable for is also the investor that might be more likely to have a bunch of capital gains that they, are wanting to avoid paying taxes on. So they have a different set of problems than perhaps the investor who is not accredited yet, and they have another set of problems. But what if capital gains tax rates are raised? Could they be raised? Could they be retroacted, at the end of this year? What do you think about that, Sean?
Yeah, there's been a lot of talk about that, and yeah, tax rates can change. It's up to the Congress to make those determinations, and in combination with the executive branch of the federal government. But from a business perspective, I want to go back to the great analogy that Larry made with the seed and the harvest. Right, the seed is much smaller than the harvest. So I think even if taxes were raised, capital gains tax rates were raised, I think it would make a more compelling case to utilize the Opportunity Zone program to avoid those taxes in the following fashion. So if you can assume that capital gains rates would increase by 5%, which appears to be the indication so far, assume $1 million investment, 5% or more, 5% more on that $1 million investment when the taxes are due in 2027 would be about $50,000. But if you are investing that money, that $1 million, in a Qualified Opportunity Zone fund, and assume that the harvest, that's the seed, the harvest will return to you about $3 million, you're going to save about 28.8% on the appreciation. So that's about 28.8% on that $2 million is 576,000 bucks. So it makes sense to, pay that extra $50,000 if you're going to save more than $500,000 down the road.
Yeah, and Brian, I think to add to that, Sean is so right, because if you look at most of the deals out there, the programs offered, you really want to look at what the internal rate of return is they're talking about. Because I've seen some that had, 8-9% total returns. Well, I'm not sure I'd lock up the money for 10 years for 8 or 9%. But if you get in the mid-teens or higher, now you're talking, because what you really want is a harvest at the end that's worth it if we're using the numbers that Sean had. And if you've got that kind of harvest at the end, then it's definitely worth it. And so it's the thing that the biggest mistake people make on tax strategies is they look only at the tax strategy and not at the investment itself. And what I like to say is, if you wouldn't do that investment without the tax strategy, you shouldn't do that investment.
Yeah.
And, today in our business, there's a lot of 1031 DSTs out there where people are buying existing real estate, which you have to in a DST, at like 3% cap rates. Well, that means I hope you get your money back. But what I learned in real estate when I became a real estate broker back in 1985, by the way, Jake, way back in 1985, when I became, before Jake was even thought of, when I became before his parents even met, I became a real estate broker back then. And what we were taught was that when existing gets too expensive, go develop, because that's what you should do. Well, the opportunity zones encourage development. And I love that, because I actually think in real estate, that's what people should be doing today.
I was 10 years old in 1985.
Now you're just rubbing it in. You guys are just, I don't even know.
I was in
what
fifth grade.
Yeah, so.
Mrs. Gibbs was my teacher. I won the reading.
I'm not surprised by that.
I got to go to McDonald's.
Nice. And you had a 50-cent hamburger probably at McDonald's back then. Yeah.
Sean, you had mentioned that the two most popular places to get capital gains from are both stocks and then one real estate. Larry, you also mentioned DSTs, which are a 1031 product. Can you kind of explain what the difference between a QOZ is between a 1031 and kind of compare for a person who's sitting on a real estate gain this year and are looking to exchange, why might they choose a QOZ?
Sure. So, wait, now is this for Larry or is this for Sean?
Either or. Yeah.
Larry,
I know your answer, Sean. I've heard it a number of times, so I could, but no, go ahead.
No. I think I was stealing your thunder. Sorry about that, Larry. Go for it.
No, I think the big thing is flexibility. In a DST, you have to invest everything that came out of that sale. In an opportunity zone, you have flexibility. You don't have to invest everything. You can invest just the gain. You can put the principal in your pocket. So that gives you a lot of flexibility. The other thing is what I just said earlier, is that DSTs have to buy existing properties. You can't develop in a DST really because of the restrictions. So you're having to buy existing. Most of that existing property is probably not underpriced, let's put it that way, as opposed to the opportunity zone where you get the benefits of the development, which I think create higher gains. And that to me is why that's the big reason for me. Sean, I might have left out a couple. Do you have anything else you'd throw in there?
No, well, I just add, Larry, for those of you that don't know, Larry represented our fund, Urban Catalyst Fund 1, very, very well previously. And during that time, we had an opportunity to work together quite a bit. And one of the things I used to say during our webinars together, Larry, you might remember, is that the Opportunity Zone program, if you're familiar with tax-deferred product, kind of looks like a 1031 going in and then a Roth IRA coming out, meaning that you're deferring your taxes in the first half or so of the life of the product, and in the second half, you're not paying any taxes on the capital gains from a federal perspective, of course. And so, yeah, that's how I like to look at it. And I think Larry did a pretty good job explaining, there's lack of liquidity with a 1031 versus the Opportunity Zone fund. You don't have to reinvest the basis or even the entire portion of the gain, just whatever portion you're comfortable investing in, and pocket the rest.
And I've heard a number of advisors recently have clients that are selling businesses. And that's a big opportunity if you're selling a business that you couldn't do a DST, but you could do an opportunity zone.
Right.
And those are big numbers that you usually see, and being able to do something like that for an advisor to do that with their client is a big win. I mean, that's a huge win for as a tax strategy.
Right.
And Sean, can you touch on one more point about how QSEs have a 180-day look back? So for people who may have accidentally blown a 1031 exchange and either didn't designate in their 45 days or weren't able to close it in their 180 days, why might a QSE be a next step solution to still kind of get some tax deferral benefits?
Yeah, the timelines are similar on the 180-day window. There's some exceptions with the Opportunity Zone program that I don't think the 1031 enjoys, but the Opportunity Zone program, I think, is either a good alternative to a 1031, but it's also a great complement to a 1031. I don't think a lot of folks talk about this. I think Larry and I talked about this yesterday, but in the situation where an investor doesn't want to continue on in the 1031 chain, then the Opportunity Zone program may be a great outlet for them to plug in some of those capital gains and continue the deferral, and then convert that deferral into a total tax shelter on the appreciation. Or if they can't find a suitable 1031, they can utilize the Opportunity Zone as a replacement for that too. Or if there's boot, if you do have a 1031 that's successful, and to the extent there's boot from the deal that's a capital gain, you can still invest all or a portion of that as well alongside a 1031. But the thing I wanted to hit upon was an Opportunity Zone investment. I think folks should understand it could be a great complement to the portfolio alongside an Opportunity Zone investment. So you'd have a 1031 and an Opportunity Zone program, and like ours, and I'm sure like the one that Larry's representing, where a significant amount of passive loss is generated, more passive loss that's going to be utilized to shelter the passive income in the Opportunity Zone deal. And so what you can utilize that passive loss then, as Larry already indicated earlier in this conversation, is shelter the other passive income in the portfolio from, say, like a 1031 or other similar type of income producing investment. And ideally, if you balance it correctly, with the advisor working with the investor on this, you may be able to generate a totally tax neutral in a portfolio for that investor. In other words, they're not going to pay any tax on any of their investment. They've got one sheltering the other. Yeah.
You get a tax sheltered income stream while the growth is happening in your Opportunity Zone. And at the end, on that growth, you don't pay tax again. So
yeah, correct.
Sean's right. It's a great strategy for a rep to utilize with clients.
Absolutely. Larry, Sean, I think that was a great summary of what a QOZ is. Brian, hope your clients will get a lot of worth out of this. Would you mind telling everyone, what are the next steps? What do they do if they want to learn more about qualified opportunity zones? How do they reach you? Would you mind wrapping this up, Brian?
Yeah, absolutely. If you have questions, if you're looking for somebody to talk to about this, please contact me. You can find me at tampafinancialgroup.com. And so my email and phone numbers are on there. And we are an independent firm. I am a certified financial planner. I've been in the business 24 years, and working through firms like Independent Financial Partners, I'm able to access experts like the two gentlemen here today. And we bring in the right experts at the right time to solve the right issues for each client's particular needs. So give us a call, and we'll be happy to see what we can do to help. So, and thank you both. Thank you, all three of you, for being here today. And I think this was great. Appreciate your expertise.
Thanks for the opportunity.
That's right. Thank you very much.
Yep.
Thank you, everyone.